Given hawkish notes from the Fed minutes in December and jobs numbers that came out last week, investors appear to be rethinking their bets on interest rate cuts in 2024. Right now, investors are pricing in only 5 or 6 rate cuts instead of the original 6 or 7, and a 75% chance of the first rate cut in March, which analysts fully priced in by the start of this year. And our next guest foresaw a rate cut starting in March, but does he still think so? Let's bring in Thomas Lemons, who is the Jefferies senior U.S. economist, to discuss more. Great to have you here on set with us.
Thank you very much. Appreciate it.
So let's discuss this and where your thinking lies right now as we're just in the second week now, beginning in 2024.
Yeah, it seemed like in that December period after rates started to fall, everybody had to kind of redo their overall outlook, and then they did, and now it seems like we're talking about that again, right? I've been a little bit more patient, and we'll see if that actually ends up being the correct move here. But I think that just with the sense of kind of continued disinflation, and as inflation continues to go down, how steady nominal rates increases that real rate. This concept that Governor Waller and others at the Fed have talked about recently. That was always kind of my primary motivation for why I thought they were going to be cutting as soon as March, right? Because I do think that in the months ahead we will see some more positive news on inflation. Then it seemed like the economy was picking up a little bit more, and I was starting to kind of feel a little stronger about it. Friday at 8:30, maybe a little weaker about it. By about 9 o'clock on Friday, I think I was back to being more confident about it, right? Because the top line numbers for the employment data that we got on Friday, pretty solid, but most of the details, I think, are telling a story that demand for labor has cooled off quite a lot, and that we're going to see that more on the supply side as we go forward in the next few months.
Thomas, I'm curious to get your perspective on how this compares to when you've done this prior, when you're trying to game out, I shouldn't necessarily say rate cuts, but when you're trying to game out Fed officials and policymakers and what that next move is going to be. How much more difficult? Is it much more difficult this time around, given the fact that the scenario that we are in right now is almost unlike anything we've seen in the past?
Yeah, no, it's extraordinarily difficult, right? For better or worse, the majority of my career has been in the sort of 2010s period where Fed rate forecasts weren't all that hard to do, right? Then they got a lot easier to do when the Fed started raising rates because they just told us that they were going to raise rates 75 basis points at a time, right? And now I think you see the difficulty, not only on the private side, but also with the SEP, right? Like, when the Fed puts out their dot plot, you can see in the post-meeting press conference this sort of like pick-apart question process of the inconsistencies of one thing versus another. And you have to deal with that on the private side too, right? So I do think that we are in relatively uncharted territory, just given the impact of communication on financial conditions and the focus on the markets and how that affects the economy. But at the end of the day, I think that it's actually, the playbook has been set from much longer ago, right? Which is this sort of nature of the economy overheats a little bit, Fed raises rates, eventually they leave them high for too long, and then things start to slow down, right? So I don't think maybe March may be a little bit too early to be starting to think about that, but certainly in the second half of the year, I think that that's reasonable.
When do you think we see a stronger turnover in the consumer as well, playing all into all of this as the Fed is continuing to kind of balance its own scale of full employment plus where the consumer is lining up?
So again, I had thought that we were going to see that as soon as this holiday season. All this notion of buy now, pay later becoming too much of fuel for consumption, and certainly the other credit card metrics and things starting to worsen.
Which again, a heavy promotional cycle we should add as well. Yeah. So not necessarily apples to apples.
That's true. Yeah, no, that's a good point. And I think that the full story fully, needs to be written at some point here on we're just looking at kind of the initial goings, right? But in any case, it seems like it definitely wasn't as worse as it could have been, right? So the rethink that I've been having on this is, we focus a lot on these credit measures and buy now, pay later and things like that. And that affects the sort of bottom 2/3 of the income spectrum quite a bit, right? And I had thought that there was this notion that we had inflation fatigue, that price level problems that were going to cause a slowdown in spending. But it seems like the top end consumer has actually been able to sort of offset a lot of the weakness that we see in the bottom, right? The muddle through story for the economy, I think, is that, right? Which is that you can have this K-shaped recovery where people who do better support more growth and vice versa. It's just a question of where the sort of fulcrum point of that K is, right? I had thought it was relatively high, but it may actually be pretty low.
Do you think the Fed will be able to get inflation under control, avoid any real deterioration in the jobs market, and be able to avoid a recession? Where do you stand on that in terms of your base case?
So I don't think that it's particularly likely that you get all the way down to 2% without getting unemployment up to like at least sort of 4 to 4.5%, right? I mean, that, there's human cost to that with unemployment going up, but that's not any of the sort of disaster, big recession scenarios, hard landing scenarios that we had talked about before. I think that that's reasonable. The problem that I have is that once you do get inflation up to 2 or down to 2% and unemployment kind of hovers between 4.5, the economy still feels very sensitive and very kind of ripe to generate inflation again afterwards, right? Because we are still in a demographic environment that's seeing the prime age workforce continue to dwindle. And that just makes labor more sensitive to supply shocks and demand swings. And the idea being that would lead to higher wages and then another round of inflation. So that's the Fed's really tricky job is, if they are going to be cutting rates, I don't think that they want to cut rates five or six times like the market has priced in. So long as we do the muddle through, I think maybe 3 might be more appropriate, right? I think that may actually be what's in the SEP. But then we get into a whole other discussion of whether or not 2.5 is really neutral, that sort of thing. So it's another headache for them.